everyone, thanks for tuning in. My name is Mike, this is my whiteboard, and today we're going to be talking about two different bullish strategies. So we're going to be looking at a poor man's covered call, and we're going to compare it to a long call vertical spread. So they're going to look very similar, but there are some differences between these spreads, and there are some reasons why we might use one over the other. So let's get right into it, and we'll break down both of these strategies, and we'll look at some differences and some similarities. So when we're looking at a poor man's covered call, all we're really doing is looking at a synthetic covered call scenario. So instead of buying 100 shares of stock right here, we're going to be buying an in-the-money call in a further dated expiration or a back month expiration. And we're going to use that call to replicate that long share of stock, or the long 100 shares of stock. It's not going to be that full replication, but it'll be pretty close, which is why we choose this strategy when we're looking for a synthetic covered call strategy. So let's say we've got an in-the-money call in July that we're purchasing, and that is $7. So we have to pay $7 of debit to purchase that call. And we're going to sell an out-of-the-money near-term call, or a front-month call. And we're going to sell that against that long call that we've purchased, and we're going to sell that for $1.70. So we've got ourselves a situation where we're basically straddling the stock price, very much like a vertical call spread, except we have two different expirations. So we're buying the one in July that's further dated, and we're selling the one in June that is the near term. So we have a sort of calendarization of this vertical spread. So we are going to look at a debit call vertical spread now, and we're going to basically have the same exact setup where we have an in-the-money call that we're buying, and we're selling that same exact out-of-the-money call, except the difference here is that we're in the same expiration. So we're going to be purchasing this call in June, and we're going to be selling that same call in June as we did up here. And by creating this same expiration and staying in the same expiration, we have a very linear P&L graph. So we're going to be profitable as the stock price goes up to our short call here at 80, and then it's going to flatten out because we can't be more profitable as the stock price goes up, because that's where our profit is capped. So anytime we're selling a call against a call in the same expiration, or even a call in the next expiration, our profit is going to be capped directionally. But there is a difference between a poor man's covered call and the vertical call spread, and that's the volatility factor. But let's go on to the next slide, and we'll really dig into the poor man's covered call first. So when we're looking at a poor man's covered call, there's a few things to note. Number one is that it's really hard to calculate our max profit and break-even levels because of the fact that we are dealing with different expirations. So different expirations are going to react to changes in volatility differently. So usually a longer dated option is going to have a much bigger effect, or it's going to be affected more by a change in implied volatility than a shorter dated option. And that's because we have a lot of days on this July expiration, but not too many days on this June expiration. So if there's changes in implied volatility, the one with more days till expiration is going to be affected much more than our shorter dated one. And because of that, when we have a change in implied volatility, it's going to affect this July option more than the June. And because of that, we're going to not really be able to calculate our max profit or break even. Another big point I want to point out is that when we come to the June expiration, this call that we've sold might expire out of the money. So let's say the stock price is at 79 and we're right at the June expiration. So this call should expire out of the money and worthless, but we're going to be left with that long July option. So when we look at the implied volatility factor, we're going to have a long option that we're still going to be long, but we're no longer going to have that short option, because at expiration, out of the money options will just disappear. So depending on where implied volatility is, the value of this July option could be very, very different. It could be worth $7 still, or maybe it could be worth $9, or if IV has collapsed, maybe it's worth $5 or $6, where it's really close to its intrinsic value. So it's hard to calculate our max profit because of that. And since we usually look at our max profit, or we try and get a gauge of our max profit to look at our break even, we're going to have a hard time calculating that break even as well, because we could very well break even if the stock price is closer or further away from that long call. But depending on where implied volatility is really what's going to drive our break-even point and our max profit. But there is one thing we know with a poor man's covered call, and that is that it's a defined risk trade. So we're looking at a defined max loss. Now I do want to point out that we don't execute these trades in volatility instruments because volatility instruments are a little bit different, where if I was executing this in Apple, there is a mathematical relationship between the front month and the back month. But when we look at a lot of the volatility instruments that are based on futures contracts, different expiration months or different expiration cycles are going to act like their own underlyings. So even if I'm short this option in a volatility instrument and I'm long a different one, this short option might explode when volatility changes, where the long option might not. So for that reason, we don't really dabble in these diagonal spreads or calendar spreads anywhere where we're looking at two different expirations in volatility instruments for that reason. But let's assume that we're in a normal equity like Apple or Google, and we're looking at this poor man's covered call. So my max loss is just going to be the debit I paid for it. So if we see that I've purchased this for $7 and I'm selling a call against it for $1.70, the $1.70 reduces the basis or cost basis on my long July option, which is why my max loss is only going to be $5.30 or $530, regardless of where the stock price is. So what we're looking for with this strategy, because of the volatility factor, we're looking for an IV expansion. So you'll see us deploying these strategies a lot in low IV environments where we might not have a lot of directional movements just yet. We might have an assumption like right now I might be bearish on the market after seeing so many days where we've had a couple of up days. I might be bearish on the market, so maybe I'll look at a poor man's covered put, which would really benefit from, number one, a directional move to the downside, but also an increase in implied volatility. So regardless of whether we're doing a poor man's covered call or a poor man's covered put, whatever is a diagonal spread or a long diagonal spread, which is really what this is, we're going to be looking for an IV expansion because we're long the back month future and or the back month contract, and we're short the front month contract here. So we're looking for that IV expansion because an increase in IV will definitely benefit this option that we're long in July much more than it would hurt this option that we're short in June. And again, this is defined risk, so this is a big similarity between these two strategies. We're looking at a poor man's covered call and a long call vertical spread, both of which are defined risk. But let's go on to the next slide and we'll break down the long call vertical spread. We'll talk about a few reasons why we might choose this one over the other. So when we're looking at a long call vertical spread, we're going to use the same exact scenario, and you can see that the June option, the 70 in the money June option, is a little bit, it's worth a little bit less than that July because there's not as much extrinsic value. So there's always going to be 5 points of intrinsic value in both of those options because options must be trading for at least intrinsic value to be considered fair. So we're looking at this option, and this is worth $6.60 as opposed to $7 in the other expiration. And we're looking at selling that same exact June option for $1.70. So a cool thing about this, and one thing that we can really benefit from, especially when we're looking at long call vertical spreads like this, is that we can create these strategies and we can pinpoint certain scenarios in different underlyings where we can actually trade this and buy this spread for less than intrinsic value. So if you are familiar with the cherry bomb, you might see TP talking about buying something for less than intrinsic value. So we're going to explain exactly how you can come across that right here. So let's say I've got a June 70 call that I'm purchasing for $6.60. I know right off the bat that if the stock price is trading at 75, it has 5 points of intrinsic value. So if it has 5 points of intrinsic value and it's trading for $6.60, that must mean that there's $1.60 of extrinsic value. So I take that extrinsic value and I know that by expiration, this option is going to be trading for right around intrinsic value. If the stock price stays exactly the same, at expiration, we'll see this long June call trading for $5.01 or maybe $5.02 right leading up to expiration. So if I can sell an option in the same expiration and cover or exceed the extrinsic value that is in my long option, then I've got myself a great scenario and I'm buying this spread for less than intrinsic value. So if I know that there's 5 points of intrinsic value here and there's $1.60 of extrinsic in this 70 June call that I'm buying, if I can sell a call that's out of the money for at least $1.60 or more than $1.60, I'm putting myself in a great scenario. So since I'm selling this for $1.70, I'm actually able to buy this spread for $4.90. So you just take $6.60 and subtract that $1.70 there, and I'm actually buying an in-the-money call for $4.90, even though I know that at expiration, it's going to be trading for at least $5. So $5 at expiration, but I'm purchasing it for $4.90, means that over time, this spread will actually gain value if implied volatility stays the same and the stock price stays exactly at 75. So that's exactly what TP is referring to, and what we often refer to as buying something for less than intrinsic value. We're basically just calculating the extrinsic on our long call that we're purchasing and trying to find some situation where we're looking at the same exact expiration, but finding an option that we can sell for at least that extrinsic value, or more optimally, more than that extrinsic value. So right now we're 10 cents, we've got 10 cents to work with, and since I'm buying this long call that has 5 points of intrinsic value, and this spread is really only costing me $4.90, I have 10 cents to work with, which is just the difference between that $5 of intrinsic and what I'm paying for, which is $4.90. So since I'm paying $4.90, it's roughly a 50-50 shot. So my max profit will be $5.10, which is just the difference between the spreads here and what I'm paying for it. And my break even is going to be right at $74.90. So that's another indicator. If you're ever looking at your break even and you see that when you're buying a vertical spread and your break even is more beneficial than where the stock is trading now, you've got yourself a situation where you're buying that spread for less than intrinsic value. So when we're looking at changes in implied volatility, this one is going to be virtually unaffected by IV. You might see us deploying these strategies more in low IV environments just because there's not a lot of opportunity to sell premium, but this one's not going to be affected by IV as much as that poor man's covered call will be, but it is going to be defined risk. We are just buying the spread, so this is a great one to deploy in much larger underlying. So if I'm trading something like Chipotle that was trading at between 500 and 600, maybe I'd look to get into a long call vertical spread, which gives me that 50-50 shot as opposed to buying shares of stock. It's a much more cost-effective way to get that directional exposure, and I have a defined risk as opposed to buying all those shares where I wouldn't really have that set amount where I can only lose $500 or $490. So let's compare these side by side really quick on the next slide here. So you can see that both of these are bullish assumptions. With a poor man's covered call and a long call vertical spread, I would be deploying these in underlyings that I want to go up in price, which is where you get this bullish stance from. When I'm looking for implied volatility, the main difference here is that these two strategies look very much the same, but since I'm buying a call in a longer dated expiration and selling one in the shorter dated expiration with the poor man's covered call, it's going to have a positive vega exposure, which just means I want implied volatility to expand. So for this one, I'm looking for that expansion, and this one I'm looking for that it's going to be virtually unaffected. So I might see this deployed more in low IV environments, but it's not really going to be affected by changes in IV. Both of them are going to be defined risk, and when I'm looking at a poor man's covered call, because of that calendarization of the spread, I'm not really going to be able to calculate my profit or break even, my max profit I should say. But with the long call vertical spread, since we're in the same expiration, we are going to be able to calculate the profit and that break even because we're dealing with the same expiration. So regardless of what we're dealing with, whether it's a volatility instrument or a normal equity, it's going to have a mathematical relationship and we'll be able to easily calculate that. So thanks so much for tuning in. My name is Mike. If you've got any questions or feedback, shoot me an email here, or you can follow me at DoTraderMike. Stay tuned though, we've got Jim Schultz coming up next.